What's up YouTube, JJ Invest here. Today I'm going to teach you how to invest in the stock market and just an overall stock market breakdown for beginners. So investing in the stock market is a great way to build wealth if you're young, middle-aged, or old. But it's important to start with the right knowledge. And so here's a beginner-friendly guide I'm going to give you. And before we jump into it, if you guys didn't know, I have a free Robinhood and acorns link. You can get free money just by signing up. Make sure you go check it out, link in description or in my bio of the channel. I'm gonna break it up in 10 easy categories for you to understand. First being the basics, second, the investment goals, the third, choose the right brokerage account, fourth, the different investment strategies, fifth, diversify your portfolio, six, funds and ETFs, seven, doing your own research, eight, the power of investing consistently, nine, manage risk, 10, staying up to date and learning more for yourself. Before diving into investing, it's important to grasp all the important investing strategies. So what is the stock market? The stock market is a platform where individuals and institutions buy and sell shares of publicly traded companies. Major stock exchanges include the New York Stock Exchange and NASDAQ in the US. So what are stocks? Common stocks give shareholders voting rights and dividends if the company pays them. Your basically preferred stocks offer fixed dividends but no voting rights. So a stock is basically you're paying for the stock and you get a small share of the company, which you can make profits, gains over time, or you can get paid in dividends, which I prefer, and I'll talk about that in a different video. And some other key terms about stocks in the stock market: bull market, when stock prices are rising; bear market, when stock prices are falling; market cap, the total value of company shares; and blue chip stocks, large, well-established, and financially stable companies. Number two, your investment goals. Whether you want short-term, long-term, or even medium-term investment, it's a good idea to get to know what you want before you get started. So short-term goals is like 1 to 3 years, buying a car, vacation, or emergency fund. Medium-term goals, 3 to 10 years, buying a home, funding education. Long-term goals, 10 plus years, retirement or financial independence. I prefer long-term because you can plan to retire off dividends if you can try to do that. And for your investment goals, it's important to know your risk tolerance. High risk, high reward, such as growth stocks or cryptocurrency. Moderate risk, ETFs and dividend stocks. And low risk, bonds and index funds. Number three is choosing the right brokerage account. A brokerage account allows you to buy and sell stocks. Choose one based on fees, ease of use, and other features. So some popular brokerage platforms I'm going to list below is Robinhood, Fidelity, and Charles Schwab. Out of these, I highly recommend Robinhood. It's very easy for beginner investors just like me. And in this sector, we're going to talk about account types. So there's taxable brokerage accounts, which is general investing with no restrictions, and retirement accounts, such as 401ks, Roth IRAs, and traditional IRAs. A 401k, employer-sponsored tax benefits. Roth IRA, tax-free growth, good for young investors. And traditional IRA, contributions are tax deductible. And sector number four is different investment strategies. First one being long-term investing, buy and hold. Invest in strong companies and let your money grow. Works well with index funds and blue chip stocks. Number two, dividend investing. That's where you invest in companies that pay out a dividend, which is basically profit sharing with the investors, such as you, if you buy in Coca-Cola, SCHD, or any company that pays a dividend. And what's great with dividends, it can create passive income for you, which I highly recommend. Number three, growth investing. Invest in companies that expect to grow rapidly or quickly. Mainly focuses on tech and innovation, such as Tesla, Amazon, Nvidia. There's higher risk with these stocks, but potentially a higher reward. Fourth one, value investing. Finding stocks that are undervalued using analysis. Warren Buffett uses this one a lot. And last one, dollar cost averaging. It's where you invest a fixed amount regularly, such as $100 a month into a certain ETF, and it reduces the impact of market volatility. And then the fourth sector being diversify your portfolio. Now this one's really important. Spreading investments across different assets reduces risk. And ways to diversify are like stocks, ETFs, bonds, real estate REITs, and you can even do a little bit of cryptocurrency. It's high risk, but potential for growth. Examples of a diversified portfolio would be like 50% into an ETF, 30% into individual stocks, 10% into bonds, and 10% into REITs or crypto. And for number 6, we're going to talk about starting in index funds or ETFs. For beginners, these are the safest options. So what is an index fund or an ETF? Index funds are mutual funds that track a stock index, such as the S&P 500. And what are ETFs? They're like index funds, but trade like stocks. And the best beginner-friendly ETFs would be like SPY, VOO, IVV, VTI, and more of a dividend ETF would be like VYM. The 7th section would be researching before buying stocks. Before investing into individual stocks, make sure to research them and analyze the company. Some fundamental would be revenue and growth earnings, PE ratio, like if the stock is overvalued or undervalued, the debt levels, high debt is high risk. Some of the more easy research tools you can use are Yahoo Finance, Google Finance, Morningstar, or Seeking Alpha, or your personal brokerage. And the number 8 would be invest consistently. Consistency is key to long-term wealth building. So how to stay consistent? You can set up automatic investing, follow the dollar cost averaging, and avoid market timing because it's very unpredictable to do that. The 9th section would be managing your risks. What that would look like would be like set a stop loss order, keep an emergency fund, roughly around 3 to 6 months of your living expenses, and only invest what you can afford to lose. Avoid putting all your savings into stocks. In the 10th section would be stay updated and keep learning. The stock market is consistently evolving, so it's important to stay informed. Some of the best ways to keep learning and to stay updated would be books, websites, YouTube channels like mine, or podcasts. And so I'm going to give you some of my final thoughts about what I just went over. Investing in the stock market is a long-term journey. Don't expect to get instantly rich. Start small, focus on educating yourself, and build your portfolio over time. And some steps to get started today would be opening a brokerage account, start with index funds or ETFs, invest consistently, research and expand your portfolio, and stay patient and think long-term. Wealth is built over time, not overnight. And that'll be the end of this video. Make sure you like, comment, and subscribe. Leave your thoughts down below in the comments. And if you think I missed anything, let me know down below. And I hope you guys enjoyed this video.